if there's some industrial electronics manufacturer out there that needs silver for their products, and they're watching these reports of the supply get shut down, the demand, at least on a retail level, go up, wouldn't it at least be plausible that one of these guys would say, geez, I want to get my silver. I see what's going on. Could that be what's happening now, where we're seeing a run on the bank?
I think there's definitely a run on the bank. There's been a retail run on dealers, and I think that people standing for delivery on the Comex are people who want gold right now.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And as the supply of gold and silver continues to get shut down, while the demand continues to increase. Now, Dave, I hope you're not going to point out my Wharton background, because we weren't so good with supply and demand there. But I am joined by Dave Kranzler of Investment Research Dynamics for his weekly appearance. And Dave, can you explain to myself and all the folks listening at home what is going on in the gold and silver markets? We've seen the retail demand. Yesterday, Mexico announcing that basically they're shutting down the mining industry until at least April 30th. So what's going on out there?
A lot of good stuff, a lot of bad stuff. I mean, I can try to explain the Comex and the gold bar situation if you can explain to me how Jeremy Siegel managed to get a job and keep a job at a prestigious business school.
Well, they needed someone to teach Keynesian economics, so certainly. You know.
Funny thing about him is
wasn't free at the moment, so backup plan.
The funny thing about Siegel is he gets onto CNBC and pimps the stock market. And I read an article about him several years ago. He keeps all his money in T-bills.
Well, usually that is, and I'm not going to make anything specific to Jeremy and behave myself here today, but as we often
come on.
Yeah, I'm reading the Bible again, Dave, so I'm not
new or old,
not judging, just learning to accept everyone as they are, which is a challenge when it comes to bullion bankers for sure, because we often hear people talking their book, saying this and that. They tell us that gold's a barbarous relic. Wheel Warren Buffett out there every once in a while. And yet, in fact, right before you called, was talking with Andy Scheckman and Miles Franklin again, where retail demand continues to skyrocket. Has this shifted over into the wholesale level yet?
It's hard to say, because if what's being bandied about the supply of gold bars on the Comex and in London, I don't think there's a lot of wholesale trading going on.
Yeah.
Now, this idea that there's a limited supply of gold bars is absurd, because if they want to increase the supply of gold bars, let the price rise, because then there's going to be people who bought gold at much lower levels that might decide to offer some out. So at what price would existing holders be willing to sell? And that's how you get a market going. You don't create more paper derivatives like the LBMA and the Comex are trying to do. So in terms of, I guess you could say in terms of wholesale interest, for sure, it's increased quite a bit. I don't always look at the Comex delivery reports and the warehouse inventory reports. I do from time to time, if the market is getting interesting, which it is now. And I happened to look at both a couple days ago, and I noticed that there was a big migration of eligible gold at the Comex into the registered category. Like there's over 3 million ounces that was moved into the registered category. And without going into explaining the differences per se, essentially registered is gold that's been made available to deliver. It's theoretically free and clear, title free and clear, and of encumbrances, and it conforms to the Comex 100-ounce standards. So, and I've never seen over 3 million ounces. I've never, it's rare when I've ever seen over 1 million ounces in the registered category. And all that gold was moved from the eligible category, which is the gold that investors and Comex market makers keep at the Comex for storage.
Yep.
So, and that inventory level from the previous time I had looked at it had moved down from, I think it was around 9 million down to like 5 million and change. So already about 1 million ounces has been drained off the Comex, and an inordinate amount of contract longs stood for delivery this month. I mean, there's been, if you believe the delivery reports, there's been 21,000 contracts delivered or noticed for delivery, and that equates to, you know, roughly 2.1 million ounces. I can't recall ever seeing a month where there's been that much gold that's been moved between existing holders of Comex bars and contract holders who want delivery. So yeah, I guess in that sense, I think if you're looking to buy any quantity of gold, you know, above just the typical stuff that coin dealers sell, right now the Comex is where you got to get it if you trust that the bars are going to be delivered, and you have the ability, if you would like, to remove those bars from the Comex vaults and move them to a safekeeping location of your choice. So yeah, in that sense, the institutional wholesale level of gold, of demand for gold, is definitely increasing if you go by Comex numbers. LBMA, the numbers are just too opaque to know for sure. You know, all we can know is you know, what people that I trust, that I get information from, who are close to the London gold market and have been doing this for a long time. So I pay attention to what James Turk says. I pay attention to what Alistair McLeod says. I pay attention to what Aegon von Greyers say. And then I've got some other sources where I get some information that I assume is very good.
Right. So would it be an accurate way to phrase it that maybe we don't have enough information to know for sure, but is it possible that with you describing such large amount of gold being scheduled for delivery, is it at least possible that we're seeing some sort of run on the bank, in the sense that, you know, obviously I've been hearing a lot more about the retail demand, but I have to wonder if there's some industrial electronics manufacturer out there that needs silver for their products, and they're watching these reports of the supply get shut down, the demand, at least on a retail level, go up. Wouldn't it at least be plausible that one of these guys would say, geez, I want to get my silver. I see what's going on. Could that be what is, and silver and gold, could that be what's happening now, where we're seeing a run on the bank?
I think there's definitely a run on the bank. There's been a retail run on dealers, and yeah, I think that people standing for delivery on the Comex are people who want gold right now. Now, I have yet to see a satisfying explanation for the difference in the price spread between the spot price that people watch, that is, you know, most people watch Kitco, and the, you know, the futures price. So and again, I think this is kind of, you apply Occam's razor here. You know, the simplest explanation is the best explanation. Okay, so if I'm in London and I want to buy a lot of gold, and I know there aren't any bars that can be delivered, I'm not gonna, when you buy gold, you put up the money before it's delivered. I'm not gonna put up millions of dollars to get to try and get immediate delivery now if I don't know, if I think that there's not any gold available. So what am I going to do? I'm going to go out and I'm going to buy futures and forwards in the hopes that maybe 2 months, 3 months from now there will be some gold available, and if there's not, then I can roll the contract forward. At least if I hold a contract, I'm standing in line for when that quantity does become available again. And that, to me, is the reason why. Now, the spot price ultimately is determined at the London AM and PM fix, right? So, and then the Kitco price is it's a mathematical formula that's derived, and it's a faux spot price based on, I can't remember if it incorporates Comex future prices in it, but it incorporates forward prices. And so it's a derivation of the spot price. So everything keys off of the AM and the PM London fix. Well, once the price is fixed, if the Comex decides to ram down the price, below where the where the price was fixed at, say, at the AM fix, all of a sudden what Kitco posts as spot price goes down, right? And it drives down the price even further, and then the PM fix is fixed lower than the AM, and so it's kind of it's potentially a negative self-reinforcing mechanism where, in a sense, the paper can control the price. So, but if you're a serious buyer of physical gold, you're not going to put up the money based on the spot price, because you're not going to get bars delivered. So you're going to go into the futures market, and that drives up the price of the futures, the curve. It causes the futures curve to steepen and, say out to 2 or 3 months, and then it sort of flattens again. So that's why I think there's the big spread between the spot price and the futures price. And it all has to do with, the paper derivative manipulation of the gold market. If they want supply, if they want to regulate the demand, and they want some supply to come out, let the price rise. It's that simple.
Yeah, which it's interesting because, in a sense, I know a lot of people are saying, well, we have surge in demand, supply is down, why is the price down? Although, when you think about it, the actual physical price, I'd say it's about 1,800-ish for an ounce of gold, probably around $20 to buy a physical ounce of silver. So we've seen some decoupling. And my final question for you today, Dave, is that, let's say people aren't able to get filled on the LBMA. At some point, does someone start taking delivery on the Comex until eventually the Comex hits that point where they can't deliver? I've heard people speculate that something to that effect is happening, but obviously you are the gold expert. You're Dave Kranzler, so let's hear it straight from the man.
Yeah, I'm an expert, right?
You know more than Bernanke, and he was the Fed chairman. And not only didn't he understand gold, he didn't even have any friends. Apparently, Greenspan wasn't even willing to explain it to him either. So you're in good company, Dave.
I was shocked when he admitted in front of Congress in public that he didn't understand gold and that central banks hold it out of tradition. I mean, either he's incredibly stupid.
See, Dave,
or
look at your competition. You're ahead of the crowd, man.
I do want to bring up an important point here, because I read an article on Seeking Alpha this morning, and overall it was pretty good. I liked it, and the guy's a reputable guy, Andy Hecht or Hecht or whatever, however you pronounce the last name. He's a commodities.
I'm familiar with some of his musings.
Yeah, so he was making an example of the tightness of supply in the gold market. And he referred to gold trading on the Comex. And there's a very important distinction to be made here, because physical gold does not trade on the Comex. You don't go onto the Comex and buy and sell bars the way you do on the LBMA. Okay, derivatives trade on the Comex, paper derivatives. And now they've got 4 or 5 different flavors of paper derivatives. You got the contract, exchange for physicals, privately negotiated transactions, pledge gold, warrants, and I guess presumably these ACE certificates. I forget what it stands for, but that's the ownership interest that they're trying to sell in 400-ounce LBMA bars to satisfy delivery on the Comex. So the Comex doesn't trade gold. What happens is if you are along a contract and you want to stand for delivery, you have a bar of gold that's delivered to you, but it's not delivered to you immediately. It's moved presumably to an allocated section of the Comex vault of the bank or other entity that's delivering the gold to you, and it sits there, and then you can try and remove it, and then you actually have physical possession of the bar of gold. But that's not a trade. That's just settlement of terms of a contract. And the biggest problem with the Comex is that the amount of paper gold, derivative gold that trades is many multiples of the amount of physical gold that is backing those contracts in Comex vaults. And I'm including total amount of gold eligible and registered. And so to say that gold trades on the Comex is 100% incorrect. And anyone who looks at it that way badly misunderstands the gold market. And I know he doesn't. But it irritated me when I read that. So I needed to get that cleared up. I'll probably do a blog post about it later that'll have some more concrete numbers in there to demonstrate my point.
This could be an alternate career for me. I could be a gold and silver psychologist. So it's like I can walk them back.
That's why I started my blog many years ago, because it was free couch time for me.
Yep. Well, Dave, it sure is going to be fascinating to see how this plays out. I don't think anyone knows exactly how it will unfold just yet, although careful how I phrase this. I don't think it's great that a lot of the things that folks like you and I have been forecasting for years have finally arrived. I mean, it's amazing to me. The Fed printed 625 billion last week, and everybody looks at that like it's normal. So perhaps we're getting close to the point where some of these things are more seriously priced in. So I appreciate you joining me on the show today to shed some light on that. And Dave, for folks who want more information about the gold market, I hear you write something amazing called the Mining Stock Journal that can be found at investmentresearchdynamics.com. Is that true?
That is correct. In fact, the next issue, I'm working on it now, and hopefully I will have it finished so that I can release it right after the stock market closes.
Cool. And do you want to point together with me? Say like it's in the description link below. You're going below your screen there, Dave. We can see your hand. But practice that. Description link below is where you can get Dave's Mining Stock Journal, as well as the Short Sellers Journal, which Dave have been pretty far ahead of your time. So I thank you for joining me. And folks, if you would like to continue digging into why these markets are trading so bizarrely, well, we have another video coming your way right now.